Hello and welcome to a brief recap of balance of payments. We talked about this in class, but if you need extra support, if you weren't in class, this ought to help you out. Balance of payments is basically a way to account for all the goods and services that travel across borders and the money that also therefore flows back and forth across borders. You can see it's got three categories there: current account, capital account, and official settlements account. If you kind of know what's in these categories, you're going to be fine for the AP exam. Um, I kind of doubt you would have an actual accounting problem with math, simply because I don't think they want to ding people for arithmetic errors. It's the concepts behind this that are key. So current account, you can see right there, this is all goods and services going across borders. So we compare the value of the imports of goods and services minus the value of the exports of goods and services. It does include some other money type things: interest on bonds, foreign aid. So if we give foreign, foreign aid to another country, which we do a lot, then that would be a sort of plus in our current account. Um, they also, the government subdivides this into just the receipts of sale on services compared to goods. The U.S. has a trade deficit in goods and has a trade surplus in services. But we import a lot more goods than we export services, which is why our trade deficit is really, really negative. Um, that's neither here nor there. It could potentially be bad in the future, but it's part of the deal with free trade. We buy more manufactured goods because other people can do it at a lower opportunity cost. They have a comparative advantage. The capital account is basically money. Um, so current account is basically focused on things. Capital account is focused on money. So you can see there it's foreign investment in the U.S. So savings and financial assets and real assets. So real assets would be if a foreign company purchases property here. In the 1980s, when we had a pretty bad trade deficit, nothing like now. Back then it was a really big deal. Um, a Japanese firm purchased Rockefeller Center in New York. You might know it as 30 Rock, starring Tina Fey and Alec Baldwin. Anyway, when they bought it, there was a big kerfuffle, and a lot of people thought, oh my God, this is the sign of the end times. You know, America's getting taken over by Japan, blah, blah, blah. But it's free flow of investments, and that actually added as a credit to our capital account. And U.S. investment abroad would be if we save in financial assets in another country. So if we buy, Bank of England bonds or Greek bonds, that's not likely to happen, huh, Mark Lagola? Or if we purchase real assets abroad. So whatever we have a deficit in, which we do in the current account, has to be offset by some credits in the capital account. So in other words, if we're buying a lot of stuff from foreign countries, buying more than we produce, then we have to get money from somewhere to finance that. The official reserves or official settlements account, as it's sometimes called, is just a way to account for the other two. There are statistical discrepancies. It's an interesting thing that most textbooks don't really tell you what's the cause of the statistical discrepancy. And I've never seen anything ask about it ever. And so, frankly, I'm not curious enough to go bother looking, especially in late April. But nonetheless, the whole idea is that if the current account and the capital account don't balance, right, it's called balance of payments, meaning that they have to equal zero. Our government, Treasury Department specifically, and sometimes the Fed will actually buy foreign currency or sell foreign currency to make up the difference. That's all you need to know. All right, so the bottom line is this: current and capital accounts have to equal zero, and it's done by adjusting the official reserves account. So if we have a current account deficit, we got to borrow from abroad more than we lend abroad. And any difference between the two is covered by the Treasury Department buying stuff. There you go, summary: goods and services, physical financial assets. Official, fix the difference. If you weren't here in class and you didn't have a chance to do Activity 52, or if you're going back to look at Activity 52 in the evening and want to look at this for some help, I I'll give you a key and we'll check it in class. But it's definitely helpful in understanding this stuff. I think that's pretty much it. Have a nice day.